Hi there, in this masterclass we are going to take a look at an introduction to options trading and options markets. We will cover what options are, we will look at some options terminology, and we will look at why we would use options. So first of all, what are options? Options are a type of derivative product. They are a derivative as the price of the option is linked to the price of an underlying asset. Like futures markets, which we have a separate masterclass on, options are contracts. Options give the right but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. So let's look at some of the options terminology. We're going to look at call options, put options, strike price, and expiry date. Call options. The right to buy is called a call option. A call option is the right to buy the underlying futures contract at a certain price. Put options is the right to sell. The right to sell is called a put option. A put option is the right to sell the underlying futures contract at a certain price. The strike price. The strike price is also known as the exercise price. The strike price is the pre-agreed price at which you buy in the case of a call, or you sell in the case of a put, an underlying futures contract when the option is exercised. Expiry date. The expiry date is also known as the expiration date. An expiration date in derivatives such as options or futures is the last day the derivative, in this case an option, is valid. Before an option expires, the owner of an option can exercise the option, which is take delivery of the underlying asset, close the position to realize any profit or loss, or let the contract expire potentially worthless. Why use options? Speculation. A bull of an underlying asset may buy a call option or sell a put option. That will be the same as having a positive bullish view of the underlying asset. A bear on an underlying asset may buy a put option or sell a call option. Again, this would be an expression of a bearish view. Options are leveraged, so this also offers geared profits and potentially geared losses. Hedging. Options were originally invented not for speculation but for hedging. Hedging is a strategy that reduces risk at a reasonable cost. When used for hedging, we can look at using options like an insurance policy. If we are concerned an asset that we own may go down in price, we might buy a put option for protection. If we are concerned an asset that we are short of may go up in price, we might buy a call option, again for insurance or a protection. So in this introduction to options, we've looked at what options are, we've looked at some of the options terminology, and we looked at why any user or trader, investor may use options. This has been Steve Miley for The Bull, and please do join us again on thebull.com.au and thebull.asia. Stay bullish.